Hey there, fellow traders. Welcome back to our channel. In today's video, we are going to dive into a powerful trading strategy that allows you to trade without worrying about the price action. Yes, we will be discussing hedging and how it can be used to trade profitably without worrying which way the market goes. Before we begin, make sure to hit that subscribe button and ring the notification bell so you never miss any of our trading tips and strategies. Let's get started. Hedging usually involves entering an initial trade with a take-profit level in any direction of the trader's choice and then deciding on a hedging or recovery zone. If the price goes against the initial trade direction and reaches the other side of the recovery zone, then the trader will open another trade in the opposite direction with a higher lot size with the same take-profit level. However, if the price does not reach the second trade's take-profit level, the trader would open a third trade in the opposite direction to the second trade when the price reaches the other side of the recovery zone. This process will continue until one of the trades reaches the take-profit level while achieving a total profit, or at least a break-even level considering all open trades. When any of the trades reaches the take-profit, all open trades are closed. In this example, the hedging or recovery zone is 20 pips, while the take-profit is 60 pips. Assuming the second trade hits the take-profit and the pip value is $1, the trader would get a profit of $84 from the second trade while incurring a loss of $80 from the first trade. However, the trader would still have a $4 profit. But let's say that the second trade didn't reach the take-profit either, and the price is going up again as given in the illustration. Now let's see what would be the net profit loss if the third trade hit the take-profit. We would have two winning buy trades each with one lot and 60 pips take profit, giving us $120. We would also have a losing sell trade with 1.4 lots and 80 pips loss, giving us a loss of $112. And you can see that the trader would still have a net profit of $8. This process will continue until one trade hits its take profit target. All trades will be closed once a trade hits take profit. If you consider the recovery zone size and take profit size as variable inputs, the lot sizes to achieve the break-even level can be calculated using the following mathematical formula, assuming zero spreads, swaps, commissions, and slippage. If you are to consider spreads, swaps, commissions, and slippage, then you need to make an allowance for these depending on your broker. For example, you could increase the lot size by a multiplier, such as 1.1, so that the formula would look like this. As you can notice, if the price does not trend, there is a risk of opening too many trades with ascending lot sizes. This could lead to your account getting out of margin or balance. Therefore, hedging becomes risky in ranging markets. Therefore, it is important that you carefully select the market and the time of the initial entry so that the number of hedging trades will be limited. In our EA, you have 5 options to set the initial entry. First, you get a manual entry method where you use the trading buttons on the screen to enter your initial trade. Then, you have a specified price entry where you can set a specified price to enter the initial trade. Then you have a specified time entry where you can set a specified time to enter the initial trade. For instance, you can set the London open time as the initial trade entry time. Also, you have an indicator-based entry option. If you have any indicator that provides some kind of buy and sell signals, such as arrows, you can use them to make the initial entry automatically. Finally, we have a cloud-based entry option. Here, our cloud-based server will decide the initial entry time. Now let's do a backtest and see how it works. Let's do a test with the manual mode. Just load the EA and click on the buy button. You will notice that a buy trade is made along with a sell stop order from the recovery zone price. Also, EA has drawn 2 horizontal lines showing the hedging or recovery zone. Now let's do a backtest with a specified price entry. You will notice that the initial trade was entered at the price we specified. Likewise, you can set a specific time as well for the initial trade. Now let's look at how you can backtest with an indicator-based entry. We are using our super arrow indicator to enter the first trade. We simply need to select the entry mode and add the indicator name and color ID numbers for the buy and sell signals. Then the EA will take the first trade based on the first signal provided by the indicator. The EA is available for both MT4 and MT5 and can be used in almost any pair and time frame. We have a free demo to test your hedging strategies before you buy. If you have any questions, please feel free to leave a comment or contact us on our site. Thanks for watching and happy trading.